Hey, Happy New Year. It's Jeff with Water Street Wealth Management. Hope everyone's doing well. Hope you had a great holiday season. It's January 2nd. I wanted to shoot a quick video. Unless you've been living under a rock the past 30 days, you've probably seen some of the market news and headlines. And to say the least, volatility is definitely back. But it makes for an interesting debate, especially around holidays. People are always asking, Jeff, why is the market doing this? What should I be doing? And it's a debate that can go on for a while, and a lot of times the why is very unproductive. But I wanted to shoot a video today on some things that you can do in volatile times like this. Before I jump into that, though, just keep in mind, there's stocks and there's bonds, so it's highly unlikely that your portfolio is 100% stocks. You probably, or you hopefully have some high quality government fixed income or bonds in there. And what that does is it tends to stabilize the account, and especially when stocks are down, people with investments, they kind of flock towards high quality government investments, and those tend to be up. So you might not be as bad off as the headlines portray, so just keep that in mind. So what are some things that you can do when we experience volatility like we've seen? The first thing you can do is reassess your risk tolerance. So with times like this, some people say I'm an aggressive investor, or I'm a balanced investor, and that's fine. But when we go through volatility and movements like we've seen the past month, your true colors really come out as far as what you can stomach and really handle as an investor. So what you can do is reassess your risk tolerance and make sure that you build out a portfolio that you're comfortable with, but that also allows you peace of mind so that you can sleep at night. Not something that you want to be doing often. You don't want to be changing your allocation every 30 days or every year even, because it's disruptive to your overall performance and your results. But if a situation like we've seen happens and you can't stomach it, reassess your risk and make sure it's in line with where you want to be. Next thing that you can do is reassess your allocation. And what I mean by that is, for example, if you have 100% US stocks, say large cap stocks, you might want to incorporate some global diversification and get some exposure to other areas of the market, so that you're not concentrated so much in one particular place, and that you can again weather some of the volatility that we've seen. Third thing that you can do, and I know this is probably the hardest, especially when we see some volatility like we saw here in December. Third thing you can do is nothing. Just stick with the plan, stick with the allocation you've set up for yourself, and long term, you're going to be okay as far as achieving your goals and results that you're shooting for. I know it's tough, but if you've developed a plan that's proven historically, scientifically, stick with that plan and try and tune out the day-to-day noise with the headlines of the market. Last thing that you can do, this is kind of a bonus, something we don't recommend, but you can do it. It's probably the easiest thing to do, is sell and go to cash. By doing that, though, there's two things that happen. You solidify the losses, and you also don't stay up with inflation. So cash is paying next to nothing. Inflation is 2.5%, 3%. By selling and going to cash and just sitting on the sidelines, you're losing money just from inflation alone. So don't do that unless you absolutely have to. Again, stick with the plan, stick with the allocation you've set up for yourself, and try and weather the day-to-day noise as much as possible. So hopefully that was helpful. I hope everyone has a great rest of the week. Happy 2019, and we'll talk with you soon. Take care.